Welcome to the Jay Martin Show. My name is Jay Martin, and my guest today is Lyn Alden, a crowd favorite here on the channel. And we go asset by asset today. We talk about China, Russia, and the United States, and how Lyn is playing the energy market. We talked about the FTX scandal, how she is playing the crypto market. We talked about the scarcity of capital and how Lyn is playing the equities market. And we talked about safe haven asset classes and how Lyn is playing the gold market. So I hope you enjoy this interview as much as I enjoyed hosting it. As always, beneath this piece of content, there is a link where you can subscribe to my weekly newsletter. I publish every Sunday. It's free. I love writing it. Subscribe today and join the team. It's super fun. Anyways, here is Lyn Alden. Enjoy.
This is Jay Martin.
All right, welcome back to the Jay Martin Show. And I'm joined once again by Lyn Alden. Lyn, it's good to see you.
Thanks for having me back.
I'm excited to talk to you. Now, there's a few directions I want to go, but I want to start with a tweet that you sent out this week, and I'll just read it here. You said, if you lived in a developing country and needed to sell your house, store the wealth for 2 years, and then buy another house, where would you store that value? And the responses that you got to this question posed on Twitter just fascinated me. Everything from, you had a few people from Argentina saying they would actually just hold cold cash, whether in the mattress or in one case, maybe two, they said in the back corner of a washing machine. One individual sounded like they were actually doing this and then paying 70% upfront for their new house. Response from Pakistan, who said they would purchase a large number of automobiles and then store the wealth in automobiles, and then reference an article showing people using automobiles as a wealth preservation asset class as a proxy to US dollar. It absolutely blew my mind. And then an example from Zimbabwe referencing a gentleman who started a pension fund that was cattle based because his mother retired, received her pension. It was worthless due to inflation. So he started this business called NACO Life Assurance, and I can contribute to the pension. He converts it to cattle, breeds the cattle to achieve a return on investment. When I retire, I'm awarded the cattle that I've purchased over the years. And what did you, first of all, why did you send this tweet? What were you looking to discover, and what did you learn as a process?
So basically, I actually know people that are kind of going through that question, and it's funny because it should be a remarkably simple answer, right? You sell the house, you hold money, and then you buy when you're ready, you buy another house. That's the kind of the purpose of money. It's the most saleable good, so you hold it in something liquid and stable, and then you sell it. And I even made the analogy, I think, one point in the thread where I was like, in the 1800s, we invent electricity, but we still can't. There's billions of people in the world that have this very simple question of, if I want to store liquid wealth for 2 years, where do I do it? Because, of course, for context, developing countries often have currency problems. It could be actively ongoing, right? So it could be a very high level of inflation and currency devaluation, or sometimes they're abrupt, right? So it might not be actively raging right now, but then when you look at, for example, their country's sovereign bonds, they're junk rated, right? So the global market is concerned about risks of default, which of course would come with usually a severe amount of currency devaluation. And so basically there are billions of people in the world that live in an environment where they can't necessarily trust their local money. And then some of the responses from, so part of what I was doing was kind of just showcasing this problem. And I was also curious to see the various answers. And so some of the responses from developed market participants was telling, because they're like, oh yeah, I would just hold dollars.
Mm-hmm.
So I was like, well, where would you hold dollars, right? Because, for example, there's periods in Argentina where you'd put dollars in the bank, and then they'd say, well, we have dollar crisis, we have to just take those and convert those to pesos at the exchange rate that we pick. Sorry, you just lost most of your savings. And so you can't necessarily trust counterparties in that environment, because those are, when you deposit dollars at a foreign bank, those are now dollar liabilities to you, and their central bank can't print dollars, right? So they could default or otherwise be told to confiscate that money. And so you have people storing physical cash, which obviously one is you don't earn interest on it, so you're prone to the full brunt of even the dollar's devaluation. But then also you have obviously security risks, right, of just holding a house worth of value of physical dollars in your apartment ever. When you go out to get the groceries, you better hope that you're not robbed.
Yeah.
And again, in the context of a developing country, usually, not always, usually crime rates are somewhat elevated compared to what people are used to in, say, a developed country suburb environment, right? And so Other people said gold. A lot of people said stable coins. That's actually one of the use cases, stable coins. So for example, Argentinians, it's common for them to hold dollar stable coins because it's a way of holding dollars outside of the local banking system, right? They're still trusting a counterparty, but that counterparty is not in their country, at least, right? So they have other risks obviously with that, but at least it's the hub of it is outside of their country. Some people said Bitcoin. Obviously, the problem there is it's very volatile over a 2-year period, as we've seen recently. And so it kind of just shows that there's not a lot of great answers for people that in developing countries that want to just, especially if they're having an ongoing currency issue where they want to sell a house and then store the value and buy another house. It's a remarkably simple problem, but we haven't solved it yet.
Yeah, it should be a simple problem. And if money did what we all expected it to do, it would be a simple answer as well. Money should be simple. We shouldn't have to overthink how money is going to perform. Were there any grand takeaways for you, Lyn? Like any sort of aha moments as you read through the hundreds of responses? What really impressed me was the geographical dispersion of your responses. Really impressive.
Yeah, I'd actually say I was really impressed with all the answers I got from around the world. The part I was a little bit disappointed by, I guess my takeaway was I was surprised at how many people in developed countries have not thought this through and how they don't consider the counterparty risk, because a lot of them are like, oh yeah, I'd buy dollars or like stocks, and it's like, well, like where exactly? I mean, not a lot of people in developing countries don't have brokerage accounts with access to global equity. I mean, obviously some do, but it depends on the country and it depends on their socioeconomic status and things like that. And so I think a lot of people just didn't realize the privilege they had that is not always available in those countries, especially countries on maybe the lower end of the income spectrum of developing countries, right? So it's the ones that are even more prone to currency issues and low GDP per capita.
Right. Now, I know you asked the question in the context of developing countries, but in the context of United States, where you're based, how would you answer that question, Lyn? If you were to sell your house today, preserve the wealth for 2 years, repurchase the house, where are you holding that wealth?
So I'm fortunate that I have a diverse amount of liquid assets. I have equities, I have cash, I have all, I have Bitcoin, I have gold, I have all sorts of assets. So for me, a lot of it would probably be a good chunk of it would be in cash for a 2-year period, but I would, in treasury bonds, probably like T-bills. But I would also probably diversify that into kind of lower beta equities, things like that. Right. So I wouldn't have too much cash exposure at any one time. And so basically I have the same, we have the same problem, but at a much lower magnitude where, we're probably not going to get wiped out in 2 years. Whereas in some of those countries, you could literally lose half or 3/4, or in some cases, all of that savings in a 2-year period. Whereas in the dollars case, especially depends what happened with real estate. Sometimes it's going sideways or down. And so, your dollars might be able to kind of get through that 2-year period. But basically, even in developed countries, there's still somewhat of a challenge there. It's just a smaller one.
Right. Are you playing offense anywhere with your portfolio right now, or are you pretty ingrained in defensive positions? Talk to me about that.
So this year I've been emphasizing defense. So, short-term, like cash equivalents, healthcare stocks. I've been in energy and then also energy pipelines, which are somewhat lower beta and more income focused play on the energy sector. It's more about volumes than prices. And in prior cycles, those pipelines were anything but safe. I mean, they had too much leverage. A lot of them performed very poorly. They were overvalued. But after the 2020 washout in that space, I consider them to be pretty low risk. And so I've been in that space. Where I play offense is things like I have, say Brazilian equities, some Indian equities. So there's select emerging markets that I like. Ironically, the Brazilian currency's held up better than many. It's been one of the top performing currencies this year because their central bank's been pretty hawkish. I also I have a kind of a permanent slice of a Bitcoin allocation. Other defensive assets include precious metals and just real estate with a low fixed mortgage attached to it. So overall, I'm on the defensive side, but I still take pockets of risk and volatility.
If you enjoy my content, let's take the next step. I publish a weekly newsletter and it's free every Sunday. The link to subscribe is right beneath this video. I share my key takeaways and action items from conversations just like this and plenty others. So join me and 50,000 other investors for this exclusive content weekly by hitting that link. All right, back to the interview. Right. Now, obviously, you've been covering and been investing in the Bitcoin, maybe the crypto space for a few years. When you see collapses like we're seeing right now, on the back of a criminal scam, right? It can destroy sentiment, prices fall with that. Do you see this as an opportunity to rush in and take advantage of these cheap prices, or are you on the sidelines kind of waiting to see how market sentiment's going to respond? Like, what are your thoughts on the crypto space right now, Lyn?
So I dollar cost average in for part of my portfolio. And generally when we get these like capitulations, I usually throw a little bit extra in there just to buy the capitulation. I do think you have to be a little bit careful because we don't know the full extent of this contagion yet, right? So I wouldn't say back up the truck. I would say if someone's interested in a very contrarian space, they can layer in. That might be a way to do it. Overall, I would say it's bittersweet because I focus almost exclusively on the Bitcoin ecosystem. I'm pretty skeptical of most other cryptos other than stablecoins, which we just talked about. And a lot of those are just casinos. Those exchanges are casinos, and the DeFi protocols are about leveraging and trading tokens that are 99% not going to do well over a 5-year period, if not actually a higher percentage than that. And so there is this kind of really big sort of parasitic kind of crypto casino industry built on top of what I think is actually an innovation of Bitcoin, right? So Bitcoin is a useful savings technology and a payment technology. You can self-custody it. That's one of the key, things. That's one of the key kind of good things about it is that if you don't want counterparty risk, you don't have to have counterparty risk, right? So what we just saw was basically a tremendous advertisement for counterparty risk. And initial sources I'm seeing are showing that on chain, a lot of small buyers are taking custody of Bitcoin, and there's been a surge in hardware wallet sales, right? So at least some people, I think, are getting the memo. But it is, it's obviously a challenging environment. It's bad for price in the intermediate term, and it probably will slow down, institutional allocations. It'll probably reduce VC capital in the space. I generally think there was already an oversupply of VC capital to the crypto industry. I think a lot of that was malinvestment. And actually, the Bitcoin-only VC ecosystem is much smaller. And I think that's a much healthier space because it's not about building, it's less about leveraging casinos and things like that. And it's more about payments utility, better wallets, liquidity providers, better infrastructure, that sort of thing.
If I were to ask you what you think the biggest shift or fallout will be from the FTX scandal, and that could be maybe just broad contagion through other markets expanding outside of crypto because of the number, there's over 100 companies that will be impacted or that are declaring bankruptcy as a consequence. And if you look at the exposure to FTX, you mentioned a lot of the venture capital firms, but like Sequoia, some of the biggest names in the business, actually some Canadian pension funds had exposure to FTX. Like it was pretty broad. And so now I've got individuals like Kevin O'Leary, right? He's a finance personality on camera saying he's running to Washington today to demand regulation, right? And so if you were to speculate about what major shift or change will occur as a consequence of this latest blow up, does anything stand out to you as the most influential shift?
So my base case is that I think that the bubble we saw this time in crypto is probably the biggest bubble we'll see. And I keep joking that it's kind of famous last words, 4 years from now, we might get a bigger bubble. But I actually think the combination of the macro environment, right? So the end of like a 40-year cycle of lower interest rates, all the way to zero, all that COVID stimulus, basically I think, that bubble might be the biggest one. That might be the high watermark for how big the ex Bitcoin, crypto casino part of that industry. I think it'd be pretty hard to rival the size of what it did throughout, say, 2020, 2021. But we'll see. So I think that might be. I think there's gonna be more skepticism among VCs and institutions about what they invest in. I also do think there's a higher chance of regulation now coming. Kind of hidden in the week was that the SEC won a court case against the lesser known altcoin. And basically, found that they were a security, that they did an ICO and other aspects of the test for what is a security, And that now strengthens the legal precedent that they could use to go after kind of the vast majority of the crypto space out there. I mean, the SEC chairman has said that most assets that trade on these exchanges are probably unregistered securities, right? So this wouldn't include Bitcoin. It probably would not include things like Litecoin and other of these kind of like, say proof of work coins that didn't have like an ICO. But if a token had an ICO, there's a good chance that it's basically a security, and most of them are not registered as such. Some of them are, and so I do think that there will probably be more regulation against the onshore exchanges, ironically. So this was like an offshore exchange, but I think that it will extend to onshore exchanges, especially because that's what they have more ability to go after.
Yeah, of course. And do you think that Sam Bankman-Fried's donations to the Democratic Party will have any weighting on how this shakes out from a regulatory standpoint? I think he donated about $40 million to various Democratic campaigns. Will that influence how regulation shakes out in the sense it'll come out lighter than it would have otherwise? Or what are your thoughts? Or heavier?
Well, so before the blow up, SBF was pushing for regulation, to a very extent. He was kind of positioning himself in DC as one of the say the crypto platforms that was pro-regulation, ironically. It's kind of almost like using regulation as a tool against, other competing firms. And so I think that version's probably not going to continue. But I do think that there's going to be more regulation, and then there is kind of the, politicians can have embarrassment, right? I mean, if you were a politician on stage with this guy or got donations from him, it basically out of like, potentially out of like customer deposits, it doesn't look good, right? So the optics are really bad around that. He was one of the largest donors in the country, political donors. And so I do think that it could be used as an example. Sometimes kind of court precedents or politicians will use a specific thing as their catalyst to push through legislation. I think that this is one that they're probably going to use.
And if you were to speculate on what kind of regulation would be the answer to this, right? Anything come to mind?
Well, I think it's likely that onshore exchanges are going to have to register with the SEC and potentially also the CFTC, right? Because you have a mix of assets that a handful might be commodities, Bitcoin, maybe Litecoin, and some others, and then you have majority of which are probably securities, and so they probably would have to go through some sort of registration process. Maybe it's a simplified process. I don't really know. I think it depends on how well they do it. I mean, they could, actually Michael Saylor gave a good interview on this recently. He described it as they can go in the direction of progressive regulation or regressive regulation. So regressive would basically saying, these are all unregistered securities. You have to go through the full security process. It kind of wipes out most onshore trading. Or they can do the more progressive approach, say, okay, here's this new policy. This is how you register a token. These are the disclosures you need. And this is how an exchange, registers with both the SEC and, they could have this kind of like clear path of what you're supposed to do. So I think it depends on how much buy-in they can get. I think there is some jurisdictional battling between the CFTC and the SEC on this matter about certain, certain tokens, if they're commodities or securities or not. This also extends over into a spot Bitcoin ETF, even though Bitcoin's not a security. Gensler has, the chairman of the SEC, Gensler has cited a number of times that he's concerned about the exchanges, where the price is determined, and so he basically wants them more regulated before he would allow a spot Bitcoin ETF. And so in general, I think it'll probably focus heavily on these exchanges and the ability, kind of their threshold for what they let on their platform and what the process is.
Yeah. Okay. And how the investor, Lyn Alden, is playing this scenario is to continue to dollar cost average into Bitcoin primarily. That's the main play here for yourself.
Yeah, for me, I think Bitcoin's innovation. I think that most other assets in the space, what they do is they sacrifice some degree of decentralization to try to do something else. They try to make it faster or more expressive, and some of those are interesting experiments. But I think Bitcoin remains kind of the key innovation in that space. Obviously, you have to be careful about position sizing, volatility, things like that. But I do think that Bitcoin will have another bull cycle in the years ahead. I don't know if you've seen the full low or not. It depends on the extent of this contagion. But I would be very, very cautious about anything outside of the Bitcoin space.
Okay, let's pivot to the energy sector for a minute. And I'd love to get your thoughts. what major indicators or trends are catching your attention in the energy space right now, Lyn?
So mainly the two biggest variables are U.S. and Chinese policy, right? So the U.S. has been drawing down the Strategic Petroleum Reserve, and that's that's quelled some of the supply side shortages in energy markets. So I think that the number one context is that there's not a lot of spare capacity, right? OPEC does not have a lot of spare capacity. Shale can only grow so quickly. We might starting to see some Russian energy come off the market in the years ahead. And there's still strong growth from emerging market energy consumption perspective, right? India still wants more energy every year.
Mm-hmm.
And so there's kind of a supply side issue, and then there's we can only draw down the Strategic Petroleum Reserve for so long. I think we're probably getting towards the end of that cycle, and so that can put upward pressure on prices. And then number two is China, right? So if you look at Chinese retail consumption, construction activity over the past 2-3 years, it's been very stagnant.
Yeah.
It's partially due to the unending rolling lockdowns they keep doing, and it's also due to kind of a planned demolition of excessive leverage in the real estate market. They have kind of a top-down plan to rein some of that in. They go through cycles, but this one's been particularly austere in that area. So the combination of deleveraging and these lockdown procedures are reducing overall Chinese energy consumption compared to the prior trend, compared to the baseline. So if they ever reverse those policies, if they do more stimulus, if they do more reopening and stay open, that's an uptick in energy demand, oil demand, and so I think those are the variables to watch. Right now, there's kind of both tight supply and demand destruction, just from Fed tightening policy, Chinese lockdowns, and if those in the next couple of years, if that turns into the next upswing, that's where I'd be pretty concerned about higher energy prices.
Okay. Now, can I ask you a question? So if I understood you correctly, you mentioned that the zero COVID policy in China might be a strategy to deleverage the exposure to the housing market, to the real estate market. Did I understand that correctly?
No, I think they're two separate issues, right? So, and they've been explicit about their goals. They've basically, I think it was the president there said, he's like, houses are for living in, not speculating in, right? And so
Okay.
basically, people watching this probably know that China has a lot of very high valuations and a lot of leverage in its real estate sector. That's been kind of a known long-term issue, and policymakers there have been trying to rein that in. There have been a number of defaults, and rather than jumping in with stimulus and bailouts and things like that, they obviously try to rein in the speed with which things come down and spread it out a little bit. But they've not, they've been pretty much letting defaults happen and letting deleveraging occur to somewhat keep the strength of the currency and kind of clear out some of that leverage. And so that's something they have been pretty explicit about. That's kind of a separate issue than the whole ongoing lockdown thing. So those are kind of two simultaneous variables that are reining in Chinese overall consumption.
Do you think there's anything other than the sort of public-facing zero COVID mitigate risk for the population behind these extensive lockdowns? I mean, how long, if you were to think and speculate, how long will this continue? And is there any like control narrative behind this other than just let's keep our citizens safe? Anything else at play?
Yeah, so I'm not an expert on Chinese domestic policy. There are people, there are China watchers, for example, that cover that a lot more extensively than I do. I actually would have expected that they probably would have opened before their national Congress, right?
I thought so, right after.
Yeah, you would think that they would want a strong economy leading up to that, but they just kept that going, all the way up to that. There are fresh reports now that they're kind of aiming for the first half of 2023 for more of a reopening, but we'll see how persistent that is. Right now, they kind of have this little spike in cases, so I wouldn't expect it right away. But it does look like they might be planning. I think they can only kind of go so long with deleveraging and this kind of stagnation that they're in before they would risk less and less public buy-in about what they're doing. So my guess is next year, but I don't have a strong view. And as for their intentions, I mean, it is complicated because they use zero COVID and low cases as a supposed example of why their economic model and political model is better than the West, right?
Yeah.
They basically, so it's kind of like once they stick with it, now they're stuck with it optically, right? And so it's hard to pivot out of that. And I think they have to navigate a way to pivot out of that. That's number one. And then number two, I mean, I have some Chinese contacts there, and I mean, there's some percentage population that supports it. I mean, even some of the public buys into, that vision. And so I think it's one of those things that over time, public opinion shifts. If they realize that variants are getting more mild, it's almost impossible to do zero COVID, and that the economic stress keeps building, and so that the whole cost to benefit keeps worsening, and more people kind of turn against it. So I think they're probably going to pivot out of that next year. But like I said, I would have expected it this year. And as for other motivations, some people suspect that it's to keep a lid on energy and inflation, to some extent, and other ones view it as a kind of almost a purposeful disruption of the West, right? Because those supply chain limitations trickle into us as well. But I generally use Occam's razor here, so I think the simplest explanation is more likely to be correct. But again, I don't focus heavily on Chinese domestic policies other than the basics.
Right, and what you're saying there could be is that by keeping China in perpetual lockdown, you're creating immediate demand destruction, keeping a lid on inflation in China, simultaneously fueling inflation in the West because you're removing China from the global supply chain. Right.
Yeah, or at least you're reducing the marginal ability for China to ease some of those supply chain restrictions. Although we have seen general trend improvements, obviously compared to the worst stages of the crisis in terms of logistics.
So between, yes, United States drawing down the Strategic Petroleum Reserve, getting close to tapping that probably, if that is matched with a China reopening in Q1, right, that could, as you said, you're worried about raising energy prices, but that's the opportunity for the investors. So how are you positioned in that market, and where are you looking?
So I'm structurally long energy, so I try not to trade it too much. I just I own a number of energy producers. I own pipelines. I plan on holding them for probably 5 years or more. If we do start to see an uptick in economic activity, and I could, for example, lean more into that, right? So I would position based on what's happening right now. We're still in a kind of in the U.S. at least, we're in a demand destruction cycle. Tight Fed. Declining PMI, so Purchasing Managers Index, overall slowing economic activity, inverted yield curve, potential 2023 recession. So, I think that we have to right now kind of balance that supply side with the demand side, watch for signals, watch for pricing, watch for economic activity, see what happens. And if we do start to get that next upcycle in economic activity while we still have energy constraints, that I'd be quite bullish. But even between here and there, I'm still I don't get out of my energy positions.
Okay, and so you mentioned pipeline companies, you mentioned producers, and that's where you're looking for exposure in that market. Can we talk about the broad equities market for a minute here? And I guess my question for you, and this may be an idea that's not too well thought out, but if you look at what Elon's done with Twitter, took one of the biggest tech companies on the exchange private, massive cuts, probably driving towards profitability. Could he be showing the market there's a better way to do this? And now that capital is becoming scarce, maybe going private, maybe driving towards profitability instead of growth at all costs is an achievable model. And look, I'm going to do it first. You can follow if you want to. Could this be the beginning of some kind of a trend, Lyn? Is that too far-fetched, or what do you think?
I think that trend's already in place, and it's not even necessarily led by Twitter. It's been happening over the past couple quarters. So to back up a second, when you're in an environment of long-term zero rates, and you have a growth company, right? The cost of capital is very cheap. Your equity valuations are very high. Investors are happy to look out 20 years at your long-term growth prospects. And then what you can do is you can keep prices low, and you can just run unprofitably, and you can essentially pay a lot of your employees with constantly diluting your shares by issuing shares, paying them the shares, high valued shares that keep going up. And that works until it doesn't. And one of the catalysts that makes it not work is higher interest rates, right? Because now there's actually a cost of capital. And so that lowers equity valuations, which makes it harder to maintain that model of being unprofitable and paying everything with equity. And then you have to raise prices. But that slows down growth. I mean, it's almost like part of that growth was artificial because the prices were artificially low. And so as that kind of doom loop happens, then you get even lower valuations, and then you have to raise prices more, and until they find, they clear out the malinvestment and they find what is the actual clearing price for these products, these services. And so I do think we're seeing that across the board. There's been a number of tech layoffs. There's been a number of hiring freezes in the space. Twitter's is obviously one of the more severe cases. And so I do think this is going to be a longer trend, most likely. And so, there's labor shortages in some parts of the market, especially like, service work, blue collar work, that type of thing. But there's some of the weaknesses we're seeing is in things like the mortgage industry, the tech industry, these more white collar jobs, and actually on average higher paying jobs. I think that's where we're going to see ongoing weakness for a while.
Okay. And within the equities market, we touched on the energy sector. Are there any other industries that you're looking at, whether for defensive reasons or offensive reasons?
So for defensive reasons, I've been using healthcare as
okay, you mentioned that. Yeah. Please expand on
because
that.
there are a number of equities that are obviously most equities are down this year, but there are actually a number of healthcare equities that are flat to up this year, right? So that they haven't been as strong performers as energy, but they've been among the better performers in the market, and that's because they came into this year with reasonable valuations, decent dividends in many cases, and they're not very economically sensitive. People still consume healthcare in a recession, and so I think of when you eventually get a more risk on type of sentiment, those could lag behind. Some of this trend could reverse. But I have a number of healthcare stocks as part of the portfolio, and I still view them as being reasonably attractive at this time. So for me, defensive is things like pipelines, healthcare, cash, gold, that sort of thing. And I'm optimistic on things like industrials as well, defense contractors, unfortunately, given the state of the world. So I do think that there are more cyclical things that you can invest in as well. I think copper is interesting long term. I think there are a number of places that are interesting long term, and it depends on your time horizon.
Yeah, and you mentioned your energy time horizon is about 5 years, which is where I like to sit. Anything less than that, I kind of lose a bit of faith. Simultaneously, I guess it's harder to predict long term, but if you can get, I tend to have more confidence in secular trends, I guess. Can you elaborate on the healthcare exposure a little bit? What kind of companies are you looking at, Lyn?
Well, so I've been in health insurance companies quite a bit. I've been in diversified, blue chip drug producers, that sort of thing.
Okay.
Basically across the board, focusing on ones with reliable year-over-year dividend growth. So they're kind of like growth at a reasonable price companies. Basically, just classic dividend paying blue chip type of stocks. And so I've been, for example, I used Cigna. It's a health insurer and pharmacy benefits manager. I've used that as a key example. It recently got a little bit overstretched, so it corrected somewhat. So I think that it's possible that the healthcare factor outperformance might start coming to an end compared to how much it outperformed for the most of this year. But I do still think that it's one of the better places to be in the market, and that you can kind of set it and forget it with, again, like a 3 to 5 year time horizon. You can hold a number of these equities, and that they're probably better places to be than cash. And compared to the S&P 500, you have less exposure. The problem with the S&P 500, it's so weighted towards those big tech stocks, right? So
yeah.
And another way to play that is I like the equal weighted S&P 500 a little bit better than the normal S&P 500. There's a simple ETF that investors can do. It's harder for very, very large pools of capital to do it, but for retail investors and funds, it's a perfectly acceptable thing. And over the very long arc of time, equal weight S&P 500 has outperformed market cap weighting. And it does, it goes through years sometimes where it doesn't, but in general, that's been a trend.
Okay, we've covered crypto, energy, equities. You mentioned gold as one of your defensive positions. Has anything shifted in how you're allocating capital to the gold space? Because we've covered your strategy there every time I've had you on for the last couple of years. So are you looking at producers, dividend paying, royalty companies, physical? Where are you putting cash?
So I use the majority of it for physical. I use it primarily as a defensive asset, as a bearer asset, store of value. But I also go into, because I don't focus on the small caps. I don't have a background in geology or it's not an industry that I go deep on, right? So I focus on the larger players. I focus on the royalty companies.
Yep.
One thing to be mindful of is if you are bullish on energy, that's a significant cost for the miners. But it's not really a cost for the royalty companies. So, for example, if someone has an expectation where they expect gold to go high, but not energy, then the miners would be very well positioned. You get them at lower valuations. That's pretty attractive. If you expect both gold and energy to go up, then the ones that don't have their costs affected, like royalty companies, would probably be better positioned. But of course, you're paying a much higher valuation for that view. And so I like a mix of both. Overall, I kind of, I overweight the royalty companies, but I still have a number of miners as well.
That's where I point people when they ask me, how should I begin exposure to the gold sector, for the exact reasons you discussed, right? Gold definitely can perform well in an inflationary environment, but every other input that goes into mining gold goes up. And so those profit margins can get crushed pretty quickly. Royalty companies have some insurance against that. I like that strategy. Look, Lyn, this has been great. I appreciate your time. I always appreciate your time. Thanks for coming back. And lynalden.com for sure. Lyn Alden contacts on Twitter. Anywhere else I should point people to hear more from you?
No, that's it. Thank you so much for having me, and have a great day.
Thank you for tuning in. I hope you enjoyed this conversation. Now, if you want to take the next step, I publish a weekly newsletter and it's free. There's a link to subscribe right beneath this video, and you can join me and 50,000 other investors weekly for this exclusive content where I share my key action items and takeaways from conversations just like this and plenty others. Thanks for stopping by.